Hi everyone, Tai Zhi here, CIO of Auto Wealth. I'm sure we are all aware of the recent Fed rate hike announcement and may be wondering what's its possible impact on the economy and financial markets. In today's video, we will be sharing what rate hikes mean to you as an investor and the steps you can take to navigate through a rate hike cycle. The FOMC concluded its two-day meeting on 15 and 16 March and raised the Federal Funds target range by 0.25% to a range of between 0.25 to 0.50% to combat the rising inflation. Based on the Fed's summary of economic projections, the Fed funds rate is projected to reach 1.90% this year, signaling a total of 6 rate hikes at all of its remaining meetings this year. The aggressive tightening policy aims to fight inflation that has been driven by supply chain disruptions, the Russia-Ukraine war, and pent-up consumer demand. Despite fears that a hawkish pivot could hurt growth, Fed Chair Jerome Powell had repeatedly emphasized that the labor markets and economic growth are very strong and well-positioned to withstand tighter monetary policy.
A strong labor market, quite strong. The labor market is so strong. And the economy is so strong, a strong labor market, strong and sustained. The underlying economy strong labor market, a strong labor market. A strong labor market, the economy is very strong, is strong economic growth. The economy is very strong, a strong labor market is a strong economy, it's our strong, also very strong. The strong is very strong, remains strong. Support a strong labor market is to...
In February, the unemployment rate hit a post-pandemic low of 3.8%. And there were over 1.7 job openings for every person seeking a job. The median projection for real GDP growth stands at 2.8% this year and 2.2% next year. So, what exactly is the federal funds rate and how does it impact the economy and financial markets? The Fed funds rate refers to the target interest rate set by the Federal Reserve at which banks lend reserve balances to other banks overnight. Rate hike increases short-term interest rates and in turn, increase borrowing costs for consumers and businesses. This discourages spending, reduces money supply, and consequently, lower inflation at a trade-off of slower economic growth. Therefore, higher interest rates tend to adversely affect stocks and bond prices. That said, a tight monetary policy is necessary to anchor inflation expectations at 2% and achieve healthy, sustainable economic growth over the longer run. So, how did markets perform during a rate hike cycle? And how should you, as an investor, navigate your investments through a rate hike cycle? Over the last 30 years, financial markets experienced 4 rate hike cycles. Global stocks tend to be randomly volatile during these rate hike cycles. What is less known to investors is that global stocks generally appreciate in value over time during these rate hike cycles. 6 months after the first rate hike, global stocks move on to make a positive return. The last aggressive pace of monetary tightening was seen in 2004 to 2006, when the Fed raised rates 17 times to 5.25% to rein in inflation. Global stocks declined by 6.2% in the lead-up to the first rate hike. 6 months after the first rate hike, global stocks fully recovered, resulting in a positive return of 10.8% despite the Fed's hawkish policy. Also, it is important to note that global stocks reacted positively to the first rate hike in March this year, which suggests financial markets felt reassured by Chair Powell's repeated emphasis that labor markets and the economy is strong enough to withstand tighter monetary conditions. So, stay cool and stay the course. As rational long-term investors, commit to regular investment top-ups to avoid mistiming markets. Be mentally prepared for the possibility of central banks accelerating the pace of rate hikes more aggressively and potential adverse but temporary market reactions. If you have idle cash and unwavering holding power, make ad hoc investment top-ups to take advantage of market discounts from time to time during this rate hike cycle to earn extra returns. If you enjoyed this video, please hit the like button and let me know in the comments below what future topics you'd like me to cover. Also, remember to subscribe to our channel so that you won't miss out on our upcoming videos. Till then.